Vijay Bhambwani, that's a basic advice that we're giving people, but any specific suggestions you think people should be following right now?
Thank you, Vikram, for having me on your show. And I concur that retail traders should not be going out there and kind of deploying their money, especially in leveraged segments like options and futures. If at all you do want to dabble in them, do remember that you need to understand the game completely before you deploy money. Peter Lynch, I definitely remember, had said in his world-famous book, One Up on Wall Street, people spend more time in choosing a refrigerator as compared to trading in the markets, which is very true. I think the newbies need to understand the game, need to study the markets, maybe for a year or two, if not longer, before venturing out and trading.
But I just wanted to ask you, when you are seeing what small investors or retail investors and others are doing right now and for the last few years, are most of them following safe investing, or are a lot of them still taking high punts and high risk behavior, which could potentially be scary?
Vikram, I'm very sorry to say this, but 99% of them don't even know what they are doing. They are following advice that is available in the public domain, in the free domain. And like Warren Buffett says, risk is not in doing something. Risk is doing something without knowing what you're doing. This is precisely what 99% of the newbies are doing. I don't think they understand the ramifications of their actions. So when you tell them risk-reward metrics like the Jensen's measure, the Kelly's criterion, the Traynor measure, the information ratio, most of them draw a blank. They don't know what we are talking about. So A, there has to be financial literacy, either from the private stakeholders or maybe even from the regulator and the exchanges. I think we need to upgrade the skills of an average rank-and-file investor/trader before we can expect that our markets will move from developing markets to developed markets.
So, I wanted to say one other investment class that we haven't looked at at all is gold, right? A lot of people would be saying gold is a good thing to be looking at right now, given that there's uncertainty, there's wars happening here and there, who knows, uncertainty, turmoil. Gold typically does well, potentially high inflation scenario as well. What's your assessment of gold as an investment?
If you're not keeping 20% of your asset allocation in gold, you're missing out on something. And
hang on. Did you just say 20% allocation in gold? Because that's a way higher figure than most people would think. You're saying keep 20% in gold.
20%.
Wow.
20% allocation in gold.
Why?
I'll back it up with reason now, Vikram. I build statistical models, so reasoning has to be provided for anything that I say. Now, the whole world has gone haywire and printed unbacked currency during COVID, right? And all this money that's floating around is triggered a hyperinflation storm. If you Google search how many countries are having elections, general elections in 2024, you realize that economic data will be gravy dressed ahead of these elections. When these elections are over, the inflation will be allowed to kind of get exposed in the public domain. And what, since 3,000 years, has been our best hedge against inflation? God's own currency, gold. You're also likely to see pro-cyclicality in asset prices. So far, what you've seen is counter-cyclicality. Counter-cyclicality is asset prices going in opposite directions of the economy. Pro-cyclicality is when it goes in the same direction. So now you're going to see realignment of portfolios worldwide come 2024. And I think you're very safe in gold.
All right, Vijay Bhambwani, thank you so much for joining us. So the gold option, something that there were others who said, Feroz in particular was saying that gold may not be something to hold, but Vijay has some logical reasons for why a certain percentage of your portfolio should be in gold. So look, what does all of that add up to? We've heard from a range of experts. And I think the basic overall point that they made, invest for the long term. Don't do short-term trading, especially in the stock market or, God forbid, in cryptocurrency. If you're doing short-term investing, you'll probably burn your money. The advice you've got from the experts, it is Diwali, should put aside a certain percentage of your money in financial assets and in other assets. Build up for your retirement. And that means having a diversified portfolio, as you just heard from Mr. Hiranandani. In case you don't already have a house, you might want to start thinking about acquiring a house at some point. If you don't have anything in gold, well, maybe a certain percentage of your portfolio in gold. The rest, financial assets, and have a diversified mix between equity and between debt. So have a good asset allocation, invest for the long term, and you're probably going to be in good shape.